A war can start on your screen in the morning and still make gold fall by lunch. That feels backwards, almost unfair. When missiles fly, most people expect the old safe places to rise without pause. So when the metal drops instead, they assume the danger passed. Sometimes the danger did not pass at all. If you want more breakdowns that catch the move behind the headline before it becomes obvious, stay with this channel, because what looks wrong here is exactly what makes the story worth watching. A lot of people think markets react like people do. Bad news arrives, fear jumps, safe assets climb, end of story. But markets are not one person with one emotion. They are millions of players fighting over time, policy, debt, inflation, currencies, and survival all at once. That is why the first move after a geopolitical shock can be loud, dramatic, and completely misleading. The crowd sees the explosion and buys the symbol of safety. Then prices reverse, not because the fear was fake, but because another force enters the room. And that second force is usually stronger than emotion for a while. Think about what happens when oil suddenly jumps. Gas gets more expensive, shipping gets more expensive, food can get more expensive, and suddenly inflation is not just a theory on a chart. Inflation simply means your money buys less than before. When traders believe that kind of price pressure is coming, they start changing bets fast. This is the part most people miss. Gold is not fighting only fear. It is also fighting interest rates, the dollar, and the bond market's guess about what central banks will do next. So during a crisis, gold can get pulled in two directions at the same time. One force says buy safety, the other force says rates may stay high, the dollar may strengthen, and that makes holding gold less attractive in the short run. So the metal spikes on panic, then stumbles under the weight of money mechanics. The crowd thinks the thesis died, when really the market just moved from stage one to stage two. Here's a simple way to understand it. There are two clocks ticking in every crisis. The first clock is the fear clock. It moves in seconds and it pushes money into whatever feels like shelter right now. The second clock is the pressure clock. That one moves slower. It watches oil, bond yields, the central bank, government debt, and whether the system can absorb higher prices without something breaking. And that clock is the one that decides whether a spike becomes a cycle. Bond yield sounds technical, but the idea is simple. It is the return investors demand to lend money to the government. When that return rises, gold has a harder time competing because gold does not pay you interest. It just sits there and waits to be needed. So if oil jumps and traders start thinking inflation will stay hot, bond yields can rise. If yields rise, the dollar often firms up too. And when the dollar gets stronger, gold and silver can lose altitude even in the middle of a very real geopolitical storm. That is not the market saying the risk is gone. That is the market repricing the chain reaction. If this is already making you see headlines differently, keep this channel close, because the biggest mistakes usually happen when people confuse the first reaction for the final answer. The opening spike gets all the attention. The quieter setup that comes after, it gets the real money. And by the time most people notice that shift, the easy part is already over. The average investor never gets taught this. They are taught stories, not sequences. War means buy gold. Recession means buy bonds. Rate cuts mean buy stocks. But the real world is messier, because one event can trigger several opposing forces at once. That is exactly why so many people get trapped. They buy the emotional candle, the big dramatic move that looks like confirmation. Then price pulls back, they feel tricked, and they sell right into the phase where the deeper case is still building. They were not wrong about the danger. They were early on the timing and late on the mechanics. History has done this before, not in the same costume every time, but with the same hidden pattern. An energy shock hits. People expect an instant straight line surge in hard assets. Instead, markets wobble, yields react, policy hardens, and metals spend a while frustrating almost everyone. Then the deeper damage starts spreading through the system. Higher energy costs move from headlines into factories, trucking routes, grocery shelves, electricity bills, and household stress. That is when the issue stops being a shocking event and starts becoming an economic condition. And conditions are what create long, powerful trends. A crisis that lasts one day can create a spike. A crisis that keeps leaking into daily life can reshape markets for years. That difference matters more than the first 2 weeks of price action, because metals do not only respond to fear, they respond to what fear turns into after the cameras leave. So let's break this down in a clean way. There are 4 moments that matter: the shock, the confusion, the policy trap, and the delayed realization. Most people only trade the first one. The shock is easy to understand. Something violent or destabilizing happens. Oil jumps, volatility explodes, social media goes wild, and everyone starts screaming about safe havens. This is where retail money often rushes in at the worst possible price. The confusion comes right after. Gold pulls back, silver falls even harder. Commentators start asking why the market is ignoring the crisis, but the market is not ignoring anything. It is trying to price the next consequence, not just the event itself. That next consequence is inflation pressure. If energy stays expensive, central banks get nervous about cutting rates. A rate cut means lowering borrowing costs. That can help the economy, but if inflation is still hot, cutting too soon can make the fire worse. So markets start thinking the central bank may stay tougher for longer. Now we reach the policy trap. If rates stay high to fight inflation, debt becomes more expensive to carry. That matters because governments are already drowning in enormous piles of debt. When trillions have to be refinanced at higher rates, interest costs start eating huge chunks of the budget. The medicine begins hurting the patient. And that is the trap nobody sees when they are staring at a 2-day chart. The central bank wants to look tough on inflation. The economy wants relief. The government wants cheaper financing. The bond market wants proof that someone is still in control. Those goals do not fit together neatly for very long. If you've ever wondered why the biggest trends often begin when everyone feels tired, not excited, this is why. The loud phase gets the clicks. The exhausting phase does the real work. That is usually where patient money starts building positions while emotional money gives up. The delayed realization comes when investors figure out that high rates cannot stay painfully high forever without snapping something important. Maybe growth slows. Maybe debt service becomes too heavy. Maybe the labor market weakens. Maybe markets stop believing the central bank can fight inflation and support the system at the same time. That is when metals can stop trading like a panic hedge and start trading like a verdict on the currency itself. And that is a very different game. A panic hedge is temporary. A loss of confidence in money, policy, or long-term purchasing power can last much longer. That is where the bigger move lives. Silver adds another layer to this story, and it is one reason the whole thing feels so confusing. Gold is mostly a monetary metal. Silver is part money metal, part industrial metal. That means silver reacts not only to fear and inflation, but also to worries about growth and factory demand. So in a shock, silver can act like a rocket on the way up and a trap door on the way down. If investors are scared, they buy it as a hard asset. If they then start worrying that high energy costs will slow the economy, they dump it because silver is also used in real production. It has 2 personalities, and they do not always agree. But the long-term case for silver does not depend on one scary week. It depends on supply, demand, and how much metal the world keeps needing for modern systems. Solar panels use it, electronics use it, power infrastructure uses it, advanced military gear and industrial tech use it too. So when people look at a sharp silver drop and say, see, the story is broken, they may be judging a long-term shortage through a short-term panic lens. That is like seeing a runner slow down on a hill and deciding they can no longer finish the race. The slowdown may be real. It just may not mean what you think it means. This is also why the topic matters, even if you do not own a single gold coin or silver bar, because the same pressure that eventually helps metals can hurt stocks, bonds, retirement accounts, and household budgets. If inflation sticks while debt keeps growing, the whole pricing system gets harder to trust. And when trust erodes, every asset starts getting judged by a new standard. The crowd usually wants proof before it acts. That sounds smart, but in markets, proof is expensive. By the time the bigger move is obvious, the easiest part is gone. That is why so many people buy after the breakout, sell after the pullback, and spend the whole cycle chasing confidence instead of building conviction. Meanwhile, central banks around the world have been sending their own message. For years, many of them have been adding gold to reserves. They are not doing that because they expect a quiet, perfectly stable future. They are doing it because in a more divided world, trust gets fragmented and hard reserves matter more. That should make people stop and think. When the institutions that print money keep collecting an asset they cannot print, maybe that is not a random habit. Maybe it is a hedge against a world where currencies, alliances, trade routes, and debt burdens become less predictable. And that world looks a lot like the one forming now. If you like learning where the quiet signals are hiding while everyone else is watching the flashing ones, that is exactly what this channel is built for. The obvious story gets repeated everywhere. The useful story is usually sitting underneath it, waiting for someone to connect the dots. And this is one of those moments. A good picture for this whole setup is a beach ball being held underwater. The hand pressing it down is made of higher yields, a firm dollar, and short-term positioning. But the air inside the ball is still there. If inflation keeps building, debt keeps straining the system, and confidence keeps thinning out, that pressure does not disappear. It stores energy. So what should people actually watch from here? Not just the daily metal price. Watch whether energy costs stay elevated. Watch whether bond yields keep rising or start losing momentum. Watch whether the central bank sounds trapped instead of confident. And watch whether governments look comfortable carrying debt at these levels. If oil cools fast and supply lines normalize, some of the pressure can ease. That matters. A story like this is not magic. It needs fuel. But if the energy shock lingers, then the market has to keep wrestling with inflation pressure, policy pressure, and debt pressure at the same time. And that is where the stakes get bigger than one trade, because a system can handle one problem for a while. It can even handle two. But when inflation, debt, politics, and geopolitical risk all start leaning on each other, every decision gets worse. Every fix creates a side effect somewhere else. That is why the smoothest narratives are often the most dangerous ones. Gold should have gone up, but it didn't, so forget it. That sounds neat. It also erases the entire middle of the process, the part where markets move from event shock to structural stress. And structural stress is where long trends are born. Most people cannot stand that middle. It is too confusing, not dramatic enough to feel exciting, not calm enough to feel safe. So they leave. They sell the thing that stopped entertaining them. Then, months later, sometimes years later, they watch it move without them and call it surprising. It was not surprising. It was just delayed. Markets do that all the time. They react instantly to noise and slowly to reality. Then, once reality is impossible to ignore, they reprice with an aggression that makes the earlier hesitation look absurd. That is the psychological edge in this whole story. Not genius, not magic, just the ability to tell the difference between a broken thesis and an uncomfortable timeline. Those are not the same thing, but people treat them as if they are. There is also a difference between trading and owning. A trader cares about what can happen this week. An owner cares about what conditions are building over the next year or two. Problems begin when people use short-term price action to judge a long-term case. That is like grading a full season after the first quarter of the first game. So no, a sudden drop after a geopolitical shock does not automatically mean the hard asset case failed. It may simply mean the market is passing through the part where higher energy costs lift inflation fear inflation fear lifts yields, and yields delay the metal move. The market can be early, late, and directionally confused all in the same month. That is normal. If you are the kind of person who would rather understand the setup than be comforted by the headline, make this channel part of your routine, because moments like this separate people who read charts from people who read systems. And systems are what decide where money flows when the easy answers stop working. The next leg of a trend usually begins before the public feels ready for it. Here is the bigger point. This is not only a gold story. It is not only a silver story. It is a story about what happens when the world becomes more fragile while the financial system is already overloaded. Metals are just one way that stress shows up. The deeper issue is trust. Do people trust inflation to cool without more pain? Do they trust central banks to balance growth and price stability? Do they trust governments to service huge debts without weakening the currency over time? Do they trust the next crisis to be solved cheaply and cleanly? Those are heavy questions. And when trust starts getting expensive, hard assets begin to matter differently, not as a trade of the week, not as a dramatic headline prop, but as an answer to a much older fear, the fear that paper promises can be stretched further than the public believes. Once that fear wakes up, price can move a lot faster than narratives do. That is why the first drop can be so deceptive. People think a falling price means falling risk. Sometimes it means the opposite. Sometimes the market is being squeezed by short-term forces right in the middle of a long-term setup getting stronger underneath. That is the contradiction almost nobody is trained to sit with. And yet that contradiction is where some of the most important opportunities begin. Not when the story feels clean, not when everyone agrees, not when television panels nod in the same direction, but when the facts are messy, the timing is annoying, and the deeper pattern is still taking shape below the surface. If this entire period ends with cheaper energy, easier debt math, calmer politics, and stronger faith in money, then metals may not need to do much. That is the fair version of the argument. But if energy remains a pressure point, debt remains a trap, and confidence remains thin, then the pullback that shook people out may end up looking very small in hindsight. That is the version too many people dismiss too early. So when you see gold or silver fall during a crisis, do not ask only, why isn't it acting right? Ask a better question, what other force is overpowering the fear right now? And how long can that force last before it turns into the next reason the metal rises? That question is where real understanding begins, because the market's first answer is often just a reflex. The lasting answer comes later, after inflation has had time to spread, after debt has had time to pinch, after policy has had time to disappoint, and after confidence has had time to crack. By then, the move no longer looks confusing, it looks obvious, but obvious is usually late. The people who win these periods are not the ones with the fastest emotional reaction. They are the ones who can survive the uncomfortable gap between what should happen eventually and what is happening right now. That gap is where conviction gets tested. It is also where the crowd usually hands over its position to someone calmer. So no, the story was never just about whether a war made metals jump for a few days. The real story is whether a shock adds pressure to an already strained system. If it does, then the first reversal may be a detour, not a verdict. And detours are where impatient money gets lost. The first move belongs to panic. The lasting move belongs to pressure.